Hi guys, Ben here and welcome to Motivation to Invest. Now I've had a number of questions from you guys asking, Ben, what is the best investment strategy for beginners? So in this video, I'm going to reveal my top 5 index funds and why they are one of the greatest strategies for investors, whether you're a beginner or a pro. Let's dive in.
Coming in, flex. I just wanna win.
Before we get started, go ahead, smash that like button and subscribe if you haven't already. Be sure to turn the notification bell on, that way you'll get notified when I release future videos and stock picks. It's good to be first on the scene when an interesting stock is at a great price. So what are index funds? Index funds are basically a basket of stocks which track a particular segment of the market. For example, the S&P 500 tracks the 500 largest and best performing companies in the USA. This is often seen as an indicator of how well the US economy is doing. So what are the benefits for you guys? Well, index fund investing is one of the greatest ways to invest, as it's passive, practical, low cost, and diversified. As in one single investment, you're automatically diversified across hundreds of companies. They also average a consistent great performance. For example, the S&P 500 has averaged approximately 10% return over the past 90 years. So as the great Howard Marks would say, index funds allow you to be in that middle ground of great returns with low risk. Index funds such as the S&P 500 have managed to achieve these returns despite multiple market dips, market crashes, and depressions. From the Great Depression in the 1930s to the dot-com bubble in the early 2000s and the financial crisis in 2008, recessions and stock market crashes have been, gone, and the market has recovered even stronger. So can't you just pay a professional on Wall Street to manage your investments for you, pick the greatest stocks, make the greatest decisions, and get the greatest returns? Yes, you can. That is called an actively managed fund. However, the irony is, on average, these actively managed funds have not outperformed the market, i.e. index funds. For example, when the great Peter Lynch was managing Magellan Fund at Fidelity Investments, they beat the stock market, and Warren Buffett's firm also beats the market, amongst a few select others. But one of the main reasons these actively managed funds don't beat the market for the investor is not just because of the skills of the people on Wall Street, it's due to their very high fees. For example, the average actively managed fund takes a fee of approximately 0.75% per year. So if you had $10,000 invested or £10,000 invested in the UK, they would take approximately £75 per year. Now that doesn't sound a lot, but these fees do add up and compound over time, especially as your portfolio gets larger. Also, they take 0.75% of your whole portfolio amount, not just the returns or lack of returns they've gotten you for that year. This actually works out as if they take 7.5% of your earnings every single year, which is a lot. Now, if you compare this to index funds, they have an average expense ratio of 0.08%, which means index funds are approximately 10 times cheaper to hold over the long term. So now I've explained to you the benefits of index fund investing and why it's a great addition to any investor's portfolio. Here are my top 5 index funds for you guys to invest in. First on my list is one of my favorite index funds, the Vanguard S&P 500 ETF, or VOO. This is one of the lowest cost funds from the great investment firm Vanguard, which tracks the prestigious S&P 500. That is the top 500 best performing and largest companies in the USA. Its top 10 holdings include companies such as Microsoft, Alphabet, the parent company of Google, Facebook, Amazon, and many, many more. So diving into the details of the index fund here, we can see that its 52-week low was $200.55 and its 52-week high was $311.59. Its dividend yield is approximately 2% and its expense ratio is a very, very low 0.03%, which is fantastic. Now, due to the recent health crisis and thus stock market crash, The year-to-date return for this fund is currently minus 10.56%. However, looking at the past performance of the fund over the past 5 years, we can see it has an average return of over 9% per year. In 2019, it even returned over 30% in a single year. And as you can tell, the majority of time, the fund has turned a profit for its investors, apart from 2015, 2018, and 2020 as of yet. Looking at the sector weightings, we can see it's heavily focused on technology stocks, consumer cyclicals, financial services, and consumer defense. Its PE ratio, or price to earnings ratio, is approximately 18. Its top 10 holdings even include Berkshire Hathaway, Warren Buffett's incredibly successful investment firm. Coincidentally, Warren Buffett personally recommended this fund due to its great performance and extremely low expense ratio of just 0.03%. For every $10,000 invested, it costs you just $3 in fees. This makes it an ideal fund to hold for the long term. Next on my list is the SPDF S&P 500 ETF, or SPY. SPY is a heavily traded S&P 500 ETF, which was the first publicly listed ETF in the USA, formed in 1993. The main difference between this fund and the previously mentioned fund is that it tracks the S&P 500 in real time. This makes it ideal for traders, as it's also very liquid. However, for this increased accuracy, you do pay a higher fee of 0.09%. Number 3 on my list is the Schwab US Dividend ETF. This is the ideal index fund if you're the type of investor who wants that passive dividend income which comes from high-yielding dividend stocks. With this type of index fund, you can have the dividends be transferred quarterly or annually directly to your bank account, or have them reinvested back into the fund for bigger growth. This index fund tracks the Dow Jones US Dividend 100 Index, which is a collection of the 100 most highly reliable and high-yielding dividend stocks. Next on my list is the Vanguard FTSE 100 ETF. This tracks the FTSE 100 Index, which is the top 100 largest and best performing companies in the UK. Holdings inside this fund include many of the large oil companies such as Shell and BP, in addition to property development firms, pharmaceutical companies, and some of the major banks. This fund is great because it offers you exposure to the UK stock market, but is also much more undervalued than the US S&P 500. Now, as Warren Buffett says, price is what you pay, value is what you get. And at the FTSE 100, you get good value. I did a full video analysing the FTSE 100, so you can check that out on the link below. Last but not least on my list is the Vanguard Life Strategy Funds. The Vanguard Life Strategy Fund compiles together a collection of some of the previously mentioned funds to give you one gigantic super index fund, which is diversified internationally. This will give you exposure to the S&P 500, the FTSE 100, the FTSE 250, Asian markets, and emerging markets. This is the most practical fund if you just want to put a lump sum of money into a fund and leave it. This is great for beginner and very long-term investors. The funds come with a variety of options depending upon your risk tolerance. From the Vanguard Life Strategy 20% Equity Fund, which has just 20% stocks and the rest in safe bonds, to the Vanguard Life Strategy 50% Equity Fund, which has 50% stocks and 50% bonds, to the Vanguard Life Strategy 100% Equity Fund, which has 100% stock and aims to achieve the highest growth. The Vanguard 100% Equity Fund arguably has one of the lowest expense ratios I've ever seen in my life, just 0.22% for all those different funds. But of course there are some disadvantages. Some disadvantages of this fund include the inability to rebalance your portfolio by buying and selling certain assets and stocks inside the fund. The fund also has a greater weighting towards larger market cap companies. This is great for stability, but bad news if you want really great returns, as studies have shown that mid-cap companies can often produce higher returns. I will be doing a full video on the Life Strategy Fund soon, so be sure to check those out. Overall, whichever investing strategy you use depends upon your budget, risk tolerance, and investing goals. However, I do believe that every portfolio can benefit from some exposure to index funds. As an example, I'm more of a high growth investor, Thus, I have a large portion of my capital in individual stock. My portfolio is currently 50% index funds and 50% stocks. However, my stock selection is currently split between 30 different stocks, which is very well diversified for individual companies. I plan to rebalance my portfolio in the future to give myself 60% index funds and 40% stocks, but with no more than 10 stocks in my fund. So I can really know these companies in detail and thus make great returns on the individual stocks, as it can be very hard to track 30 to 35 different individual stocks. So what are your favourite index funds? Comment your thoughts below. And if you enjoyed this video, go ahead, smash that like button and definitely subscribe. See you next time.
Coming in, flex. I just wanna win.